number one question for many investors today: how do they generate current income given today's incredibly low interest rates?
It's quite a puzzle, isn't it? I mean, when you've got junk bonds paying something like 5%, when you've got Italian government bonds barely at a premium to U.S. Treasuries, you know you're living in a crazy world. And it's not just that the yields are so low and making it difficult to get that income, it's that they come with a lot of risk. Interest rate risk, duration risk are such that if on long-term government bonds, for example, if interest rates go up 1%, you stand to lose 9 or 10% of the value of the bond in one go. That's wiping out 4 years worth of your income. So it's a very tricky situation indeed.
So that begs the question, what is an investor to do?
Well, you can really kind of break it down into two pieces of the puzzle. The first thing is you want to try to find investments, income generating investments, that are going to increase their payout year over year, because that's one way to deal with interest rate risk. So MLPs are probably the most broadly available sort of investment there, but you've got royalty trusts that can kind of do the same thing. You've got farmland, you've got timber, you've got pools of certain kinds of private debt, and all of these things will allow you to get more interest year after year, and that will cut down on the risk of losing their value if rates rise.
So you look for investments that can offset rising rates with increased payouts over time. What else?
Well, you can do what the pros call shorten your duration, which means, limit the amount of time that your bonds are outstanding that you own, because the longer the maturity date is, the greater risk that they have of dropping if interest rates rise. So shorter maturity loans, one of the really interesting ones is catastrophe bonds, CAT bonds. Peer-to-peer loans have those, have that characteristic, very short term. That's very popular with high net worths right now. You've got other sorts of things like leverage loans that you can utilize. You can use asset-backed securities and asset-backed consumer loans. So these are the kinds of things that will shorten your duration.
This all sounds intriguing, but how do people get more comfortable with these exotic choices?
Well, they are a little bit exotic, and therefore, the best thing you can do is invest behind a real expert in these fields. I mean, generally speaking, I'm not a fan of even picking ETFs that are investing in these sorts of things, because you want to have people, if you look at emerging market debt, for example, which is another interesting way to deal with this conundrum right now, that's a very volatile situation, and you want to have people who are really experts in the particular countries and in the particular issuers inside of the particular countries. And you don't want to leave that up to an algorithm or a passive decision. You want active, really expert managers working on your behalf. So I would say invest behind those kinds of people.